This is over the last 3 months. Only a few days ago, we were right back up here pricing in 50 basis points, maybe a hike next week for the Federal Reserve. Now we are pricing in potentially no hike whatsoever. That's how quickly things can change overnight. By the way, this little red dot right down here, this is today, this is yesterday, and that's how much this has moved. We haven't seen moves like this, especially in the 10-year, since right after the Lehman Brothers collapse in 2008. That would be September of that year. Only 3 days ago, Thursday close or Wednesday close, we were sitting at about 4.0% in the 10-year. Now we are down 3.45%. That is down over half a percentage point. Again, we don't see these moves very often, and I want to stress the volatility and what that does to the risk markets here. Here's the ICE B of A move index. That has been creeping up here, and now it looks like it's set to explode to the upside. Here is a 5-year chart. Here is a pandemic high that we saw when we suddenly closed off the world economy overnight. Well, we're heading back up to these levels. All of this tells me that there's a lot of skittishness in the market, and when we see all this volatility, it reduces the available credit, it reduces the available investment for everything else. That includes stocks, bonds, crypto, everything. Here's the US dollar index. Here's one sigh of relief. Perhaps we're not seeing a rush into the dollar. The dollar is a safe haven asset, but we are seeing a move into the yen. Here we're seeing the euro versus the Japanese yen, investors going into the more safe haven asset of the yen. That's what happens historically during these movements. Now, I want to show you what's happening to the regional banks. This is over the last 2 days. Some of these moves absolutely astonishing to see on a 2-day basis. A lot of these plays relatively stable stocks here. They don't move that much per day, and yet we're seeing moves of 50%, and that's not even including what's happening overnight. Some of these stocks now, WAL, FRC down another 60-70% overnight, guys.
Yeah, I'm looking at First Republic here too, Jared, down 63% here in the pre-market. Some very, very wild moves. Now, the chaos at SVB is having ripple effects across the banking industry, echoing the financial crisis of 2008. So what happens from here? Let's bring in Hennessy Large Cap Financial Fund Portfolio Manager David Ellison and S&P Global Market Intelligence's Nathan Stovall. Good to see you here both this morning. Dave, let me start with you. You have skin in the game in your fund. You had Signature Bank in there. Your thoughts on what the government has done here and what moves you're making this morning?
Well, it's, as a portfolio manager, I'm surprised I have time to be on TV. I should be taking care of my shareholders. But I think that, the issue is that, I think Julie laid it out pretty good in talking about the mark-to-market issues. Again, the 2007, 8, 9, 10 was a credit mark-to-market. This is an interest rate mark-to-market, a lot different. It seems to be equally as punishing. But I think, you have to accept the fact that you missed it and you're going to take a hit in the portfolio. And I think I've got a bunch of other names that look very safe, like JP Morgan and Wells Fargo, and they've gotten hit too. So, it's been a tough realization that risk and fear are still very much alive in this marketplace. And I think the electronic nature of the banking system now, people can move money very rapidly. This isn't people lined up outside with their passbooks looking to get $20 out. This is people that are calling, going on the internet and pulling, millions of dollars out very, very quickly. So, this liquidity issue is, I think, bigger than the Fed ever expected, and I think it's going to be a struggle going forward here to kind of reestablish a sense of liquidity in the system.
Yeah, it definitely feels that way. And Nathan, as is always the case when these kinds of things happen, there are some people who look at it and say, well, we should have seen this coming if you really scrutinized the balance sheet of this particular bank, which leads me to ask, where else are we going to see these kinds of vulnerabilities, even with this backstop that now we have seen put in place? Is there a chance that we could see other financial institutions fail?
Well, hopefully not. And I think David and you both put it pretty well on what drove this issue. But one of the points I want to add to that is that, this is really sort of a crisis of confidence in those institutions. And that while there was a liquidity mismatch, asset liability mismatch, you also had the two banks in question here heavily concentrated in large deposits. As you mentioned early on, the amount of uninsured deposits at SVB was way higher than what you see across the industry. It's not to say that large deposits are bad, but it allowed for the speed of withdrawals to be much higher. The other thing I would mention is that they were so heavily focused on the VC industry, which many of us have talked about over the last few days. But that allowed really for, I think, groupthink to come out as people got concerned. Similar with Signature, a little bit different story, but the fact that they had crypto exposure and what we had seen with Silvergate winding down operations last week, I think really accelerated things there. But that's the one that is perhaps more surprising to anybody. And I think one of the reasons why you've seen regulators respond the way they have, with backstopping uninsured deposits at both those institutions, as well as coming with their term lending facility. And they're hoping it's a bazooka and really assures depositors that their money is safe in these institutions by providing additional funding.
David, you mentioned JP Morgan. Others that I've talked to this morning also looking at JP Morgan, calling out its fortress balance sheet. Of course, that is a term that CEO Jamie Dimon is always highlighting on his various earnings calls. What do you do with a stock like that, and how do you see JP Morgan exposed to the situation?
Well, I think the exposure, I think for companies like that, and there's probably 4 or 5 of them like that, I think is the issue is what is the cost of funds going to be going forward, as everybody realizes that, 10